Today, I'm gonna show you what I would do if I had to start my entire trading career all over. Not just that, but I'm gonna give you a checklist and a roadmap to guide you through all of the things that I wish I avoided in the beginning, but most importantly, all of the tools and resources that I would have benefited greatly by having when I started out. And my goal by the end of this video is to give you a clear-cut path where you're gonna minimize the amount of money you're gonna lose and the amount of time you're gonna spend actively trading. Now, the first thing that traders do when they start out is fund an account with live capital with the intention and the goal of making money. Now, this is gonna be difficult, but what you have to do is you have to rewrite your brain, and instead of the objective being make money, the objective has to be to learn. Now, when I started out, of course, like you and like everyone else, I wanted to make as much money as fast as possible so I could quit my job. And the problem with that mindset is that you will essentially prioritize what you believe is going to make you money instead of what you really should be doing, which is learning properly by trading with fake simulated capital. You're gonna test with the goal of finding consistent profitability, but that could take months. And that is the hard thing when anyone gets into trading. Obviously, at the end of the day, we're all getting into trading because we want to make money, but your discipline with the objective of learning in the start is going to really make or break your trading career, because most people will start out, they'll fund their account, they'll immediately strive to make money, they'll focus on making money only and not learning. Inevitably, most people do actually have beginner's luck because they push risk, they don't understand what they're doing, and then they decide, hey, I'm doing well, I'm gonna fund my account with even more money, and very quickly that leads to a blown account and all your hopes and dreams lost. And that's why most people do quit right away. But what you should be doing is starting out with the objective to learn and trading with fake paper capital. I would have saved a lot of money if someone just told me that in the beginning. Next, I just wanna say, please do not quit your full-time job. Part of finding success trading, in order to find that longevity and profitability in the market, what is really gonna help you is by actually having another stream of income. Don't quit your job to trade full time, and even when you're making money, maybe go to part-time, but still keep some income coming in on the side. I did and was able to maintain what I was doing for long enough to the point where at that time I had enough track record, I had made enough money, I was consistently profitable. And so this shouldn't be a month to even year decision. Once, I would say, you have a couple years of profitability under your belt, you can really look at your financials, and this is all dependent on your situation, and then make the decision whether you really want to trade full-time in the means of you have no other streams of income. However, I would still recommend having some money coming in on the side. Now that I got those two things out of the way, let's just get right into it. I want to preface this by saying I've heard a lot of mixed opinions. Everyone has their own bias in trading. Everyone thinks they know what's right. But the truth is, everything works. It just depends on the individual. And I'll explain what that means, because I've been through cycles where something's worked, it stopped working, and then even though I was doing well doing that one thing, I objectively started saying what I was doing doesn't work or didn't work. And this is something that you'll encounter and run into as a trader, where you'll go through cycles of finding profitability and then having to refine, tune, or even do a complete 180 and do something different. But to start out, don't get on the internet, don't go on YouTube and just start consuming information. Do not do that. Best possible thing you could do is find one person, do your due diligence, do your research, make sure they're credible. And it doesn't have to be me, it can be anyone else, I don't care. Find one person, obsess about everything they tell you. Learn the ins and outs of their strategy. Simplicity scales, complex fails. Find something simple, apply it, stick to it, and over the course of time, it will eventually work. But I'm just saying, what happens is you're watching one trader and then you're watching another trader, and everyone gives you these opposing biases and opinions. Like I said, that's how trading is. But the problem is that You just have to be able to hone in and focus on one thing, one specific system as a whole taught by one individual. I did this in the beginning and most people do. It's called style drift, and it is something that has to be avoided. When you drift between different strategies, different styles, and different mentors, you will never find consistency in anything because you're just not giving one thing enough time. And when you ask, hey, what is enough time? I'm not gonna tell you 3 months or 6 months. I'm gonna tell you enough time. Quite literally, anything works. And so enough time is when it begins to work. But as long as you stick with it, I almost promise you, if it takes a year or 5 years, you'll eventually find consistency in that strategy. And I can say that with confidence because what you'll realize, and this is gonna help me kind of derive an explanation behind the fundamental understanding that you need to have in your trading, is that everything boils down to essentially probabilities. And it's as simple as this. You're gonna look at your win rate and you're gonna look at your risk to reward. Essentially, the more aggressive your risk to reward is, and all that means is if you wanna risk a little money to make a lot of money, you're gonna have a really low win rate. Now, on the other hand, if you wanna risk a lot of money to make a little money, you're gonna have a very high win rate. And so it doesn't matter the strategy, how you're trading, what concepts you're using, whether you're using moving averages, indicators, none of that matters. What matters is that if you are doing something consistently, which means you're identifying certain criteria on a chart and you are taking that same trade over and over and over, day by day, and you are setting those same key levels as far as the same metrics from a risk perspective, you're trading consistent risk to reward, consistent position size with a consistent risk exposure. So you're entering a trade with a defined 1 to 2 risk to reward, with a defined negative 10% stop loss and positive 20% take profit. And you are trading with 5% per position size, and you continue to rinse and repeat. And each time, whatever you're looking for, once you check off all those boxes, you're taking that trade, you'll see that over time, you'll be able to build up enough information to be able to determine the win rate. And if not, that will be a profitable strategy based off of that risk to reward. So risk to reward is going to determine the win rate you yield, and then you're either going to be profitable or not. If you're not profitable, this is where back testing comes in. Your goal as a trader is to find a balance between win rate and risk to reward. I'll give you a great example. You can make money with an 80% win rate, but you can also make money with a 20% win rate. So one guy can be over here and he just won 8 trades out of 10. And then there's another trader over here who just lost 8 trades out of 10, but they both made money. And so that's what I mean by finding a balance between risk to reward and win rate. Now, if you are trading, looking at a chart, making decisions on the fly, if you're getting into a trade without having predetermined risk and reward, that means you're not letting risk dictate your trading, you're letting trading dictate your risk. That's a lot more difficult. It's a lot more work to also trade variable risk to reward. So for example, you're trading a 1-to-1 risk to reward, and then you're trading a 1-to-3 risk to reward. And at the same time, your risk exposure is changing. So your stop loss is at 10%, then it's at 20, then your take profits at 40, then it's at 15. Well, if you're trading like that, you have to adjust your position size prior to entering the trade, but you still need that predetermined risk reward before entering the trade to know how to adjust your position size accordingly, so you trade consistently. The problem is, if you're letting risk dictate your trading, you have to make risk-derived decisions. You're only entering trades with consistent R, consistent position size, and a consistent risk exposure, which means your risk to reward's the same, your upside and your downside is the same as far as how much you're going to make or lose in percentage, and then your position size is the same. The only variable is what stock are you trading and what direction are you betting on it going. And then you're out of that trade based off of if that -10, for example, or positive 20% stop loss or take profit are hit, versus you're looking at a chart and risk is ever changing because you're looking to see some key level or some resistance level or some moving average, get hit. That's a lot harder because you can't predetermine risk before getting in a trade. So to summarize, if I was to rewind, and if someone would have told me when I started trading, the main thing you should focus on is understanding risk management, risk to reward, win rate, position size, all of this boring sounding stuff, well, that would have expedited my profitability and I would have made money a lot sooner. It's often the more complex or boring subjects that just get overlooked. Because let's be honest, who wants to sit there and learn about risk management when we can go and add 10 indicators to our chart? But all jokes aside, you just have to realize you need to find a balance between risk to reward and win rate. Find that equilibrium, go through back test, run simulated trades with paper money through historical data, play with different risk to rewards, see what those respected win rates are, and then based off that risk to reward and your upside and your downside, see what your break even risk to reward needs to be in order to, well, achieve profitability. I made a video on all of this the other day, and I actually just put together a playlist covering all of the beginner videos that are really going to take you through all these concepts, breaking down what I just talked about in this video in more depth and detail. So this was like a 30,000 foot view, but I will put a link in the description below to the playlist I want you to check out. Now, if you're interested in learning how to trade, you want to work with myself, you want to learn exactly how I trade, if you do choose to follow me, well, I'll put a link in the description below. You can apply for my mentorship group, and I look forward to working with you. Subscribe for more, and I'll see you in the next one.